Today we are with John D'Agostino. He is the head of institutional strategy at Coinbase, and he is also a board member in the Alternative Investment Management Association. Hi, John, and welcome to the show.
Thank you so much for having me, Javier. Great to be here.
It's a pleasure. I would like for you, please, to start by telling the audience a bit about your career because you have done quite a few things and you are doing presently more than I just presented you with. So please tell us a little bit more about your career.
Sure. Well, the quick version is I took a somewhat non-traditional path after business school. Instead of going into the typical investment banking training program that a lot of my Harvard graduates went to, I met this fascinating individual who is chairman of the New York Mercantile Exchange, which back then was the largest commodities exchange in the world. And it was still open outcry, meaning like there were people screaming and yelling and setting the price of crude oil every day. And I took a risk and I said, you know what, this is a fascinating world. It was at the cusp of switching over to electronic trading. And I thought that would be fun to be a part of. You learn very little substantively when you do an MBA. And you learn a lot, I think, intellectually and academically, and you make great relationships. But I wanted to sort of immerse myself in a place I could deeply learn. And the exchange floor back then was just really fascinating, exciting, and fun. And so I took a shot, and I became sort of chief of staff to this amazing individual, Vinny Viola, who went on to found EWT, which became Virtu, which is one of the most important market makers in the world. And just got the chance to learn and had some amazing experiences and spent some time in the UAE, built an exchange there. And so my career is I was I worked in the hedge fund space, but for the most part, I've always been around market structure and market infrastructure and exchanges and sort of how do buyers and sellers meet to agree on a price. That was sort of my expertise, if you will. I was trading natural gas and working for a hedge fund I was a co-founder of, and I got a phone call from Coinbase saying, this was right a couple of years before they went public, and they were looking for people with exchange experience. And I knew enough about crypto to be dangerous. I had been lecturing at MIT for a few years, and so I was studying crypto academically and blockchain academically. But again, I didn't have any practical experience. It was like I had an MBA, if you will, in crypto, but nothing real. And so two things happened around the same time. One is I began the conversation with Coinbase. And in the beginning, I worked as a consultant for Coinbase as I was just getting my feet wet. Simultaneous to that, I got asked to be on the board of an extraordinary entity called Polychain. And your viewers might know Polychain. They were kind of one of the OG first big crypto VC hedge funds. Got to meet Olaf, and they asked me to be on the board of Polychain. So for me, that was like this. I was like going back to the NYMEX days. It was like I graduated my MBA, had the academic understanding of blockchain and crypto, but I was able to learn practically at two of the most extraordinary companies in the crypto space. And then after a few years, I took the full-time position at Coinbase and became head of strategy.
Wow. I mean, that's two of companies like that, coming knocking at your door. That's I can imagine that must have been a
I got very lucky.
yeah.
I got very, very lucky. Yeah, it was a great places to learn.
For sure. Yes, and well, like I mentioned earlier, you are a board member of the Alternative Investment Management Association, which is kind of, or basically mostly the focus of our interview. And I would like to ask you about your role there because you co-founded the Digital Asset Working Group there a few years ago, and I'm curious for you to tell us about what your vision was at the moment, because the conversation, I'm sure, has evolved at the moment. And probably, I'm sure some people told you, what is this about? What are you trying to achieve with this here? And so on and so forth. So can you tell us a little bit about that?
Yeah, sure. So AIMA is a great organization. If you have any listeners who are in the investment management space and really any, broker dealers, all the vendors, funds, exchanges. It has thousands and thousands of members. It's the largest, it's a nonprofit. It's the largest sort of nonprofit industry working group and lobbying group for the asset management and investment management industry. So I recommend everyone become a member. I don't make any money off of it. I work for free as a board member. It's a nonprofit. The people who work there are great, and they just serve a valuable function for the industry. They do lots of different things like lobbying and produce best practices. The thing that I always really liked about them is they were sort of a neutral meeting place to share ideas. Because they're nonprofit, they're not, charging tons of money, and you don't have to pay $100,000 to be a speaker. And so they had the luxury of bringing the best talent to the forefront. It's almost it's like a open architecture model, similar to blockchain in some ways. So I was always a member. I was always every place I ever worked. I said you got to you gotta be a member of AIMA. I always found huge value in the phone calls and everything. And as I mentioned, I became interested in crypto academically a long time ago. I wrote a white paper at MIT with a professor friend of mine about the DAO hack, which is that seminal moment that forked Ethereum. And I was just really interested. So I got asked to be on the board of Polychain. And as a board member, one of the things you have to do is you have to sign off on the audits. And this was a long time ago. And I won't sort of call anyone out, but Polychain is a great firm. They had really, really good vendors, auditors, accountants, admins, like best in class. And I remember, and this is going back like 10 years, I was asked to sign off on the audit. I asked a very simple, what I thought was a very simple question. I said to the auditor, again, big four, big name, you would know the name, phenomenal auditor. They knew their stuff. And I said, what happens if we're invested in a company and they issue an airdrop? They just give us these tokens. Is it an asset or liability on our balance sheet, on their balance sheet? Kind of pretty standard account. I'm not an accountant, but those are the kind of questions you have to ask as a board member. And I remember because these incredible auditors, these partners, they were like, we don't know. And I'm like, but they knew. That's the thing. When I talked to them offline, they had a view, I should say. This was all very new, right? They had a view, but they were like, we don't want to be the first ones to put this view down because what if we're off? Then the PCAOB and the SEC and everyone comes down on us. And they were like, this is all so new. We don't know what to do. And I said, okay, well, I'll do two things for you. One is I will go to the SEC on a no names basis. So I'll talk to you. I'll talk to all of the big four accounting firms. I'll say, okay, what do you think the best way is to resolve this? I'll go to the SEC because I have some relationships there. This was pre Gary Gensler when they were actually open to cooperation. And I used to go in every quarter and I would say, hey, I'm representing a bunch of funds I'm on the board of. I'm representing, and I'm telling you, not representing, but I'm telling you what the accounting firms, audit firms, here's how they want to treat this. Can you give me some guidance? Now, as a board member, you should want to work with me because I represent the investors. I'm out for their interest as well, just like you. And again, pre Gary Gensler, the SEC was very open minded and thoughtful, and they loved it. They would invite me in, and we would have these great sessions, and they would give me good feedback, and I would go back. I was the liaison, if you will. While that was happening, because I was talking to all of these firms to get that view, I noticed they all had similar views. So I said, why don't we just start a phone call? And I called it, Javier, I called it the boring crypto call because we discussed all the boring issues like tax, accounting. And it started with like, 5 or 6 of my friends at these firms. And it grew and grew and grew. And suddenly I had this 500-person phone call because everybody was wanted to deal with the boring stuff. And I had a few rules. You don't sell anything. You sell by being smart. And the goal wasn't for all of us to agree, because maybe everyone agrees, but we all should know where we stood on these issues. So if you're an accounting firm and you're going to treat something this way, you should know if you're off market, if everyone else is doing it a different way. You can still do it your way, but you would at least know. And so this was a very virtuous circle because I would take the data from this call, go back to the SEC, vice versa. It was great. It was wonderful. I'll finish here. The call got to be too much. It was like I had a job. It's a big pain in the butt. Like it's a job to manage that. So AIMA, who I love, that's what they do. So I went to them and said, you should have this call. You should run the call. I'll help, but it should be your call. And they've turned that into this amazing crypto digital asset group within AIMA that now has big conferences. And so I get all the credit as the co-founder, but honestly, they took my little call and they turned it into a real wonderful thing.
Well, I mean, it's fascinating, that you made it grow to the point in which it was basically unmanageable for you. So props to you there. Now, I would like to also touch a little bit more on to go more, so to speak, onto the industry itself of alternative assets. Can you give a brief overview to our audience about what tokenized alternative financing actually looks like in the US at present, post, so to speak, Gary Gensler? Um, what are the main use cases?
So tokenized alternative financing, I'm assuming we're talking about tokenized lending. So lending to on-chain assets, both natively on-chain and also now increasingly real-world asset tokenization, right? So let's start with the basic principles. Like what everyone talks about how tokenization is going to eat the world, and Larry Fink talks about it, and there's lots and lots of reasons, right? It's better technology. It's programmable, so you can start to do new interesting things with it. But I think for me at least personally, the number one reason, right? If people won't switch systems just because one system is marginally more efficient than the other, because there's a switching cost and there's a knowledge cost, right? You don't want to switch. The analogy I always give is in my family, my wife and my daughters are all on Apple, and I'm an Android guy, and I can learn Apple. I just choose not to. Like the switching cost for me is just too much. I can't handle it. I don't want to. And I think we underestimate, even though my life could be much more efficient and my kids would be happier with me. I'm stubborn in this one issue. So I think we don't acknowledge that factor both at an individual level and also at a commercial level. So tokenization has to be more than just more efficient. And yes, getting your there are certain industries where, like, we're doing a project in payments right now where we're minimizing the cost of journalists. So if a journalist wants to go on YouTube and earn a living doing independent journalism, they can reduce the time they get paid for ad sales by 90 days. That's massive, right? So that is, but for marginally more efficient use cases, the average person doesn't want to switch systems. So we have to motivate them to do it, right? It's not just getting paid slightly faster. The programmability issue, the convenience issue, yes, but it really has to be substantive. I think the real thing that's going to pull people on chain as it is going to be lending and margin. So if you have a diverse set of assets in your life that have correlations that you should be getting offsets for, or that are difficult to loan against, if you can start to move those assets on chain and make them fungible. So you have now a wide variety of assets and you start to harmonize them on chain. And then you allow lenders to get more comfortable lending against more of those assets, but also providing margin offsets for certain types of assets. Let's say you're long gold and you're short stocks that are correlated either positively or negatively with physical gold. Those two assets naturally should be able to provide a margin offset, but it's challenging because maybe I'm a lender who has no issue accepting the stock as collateral because I know I can sell it, I know what to do with it, but I don't know how to work with physical gold. I don't know who the buyers are, the storage, all that stuff. So when you start to harmonize everything on chain, you start to make it possible for these correlations to be monitored, and you start to make it possible for the assets to be more fungible, meaning they're more easily bought and sold. That's where alternative lending, on-chain lending comes in very handy because lenders like Coinbase and increasingly others will be able to take a wider array of assets and lend against them, giving you margin offsets. So that's the basic reason for why it's a really, really good thing for people.
Do you think that's why private credit has become the largest category by market cap in the tokenized world? Yeah.
100%. Think about the problems private credit has had. The problems private credit has had recently, most famously Blue Owl, has been, and it's the classic age-old problem, it's a mismatch of liquidity and duration. Lenders want longer duration, investors want liquidity. That's how it's been since the age of man. I'm sure there were cavemen loaning rocks to each other that argued about duration versus liquidity. So that's inherent. It's what sociologists call a wicked problem. You cannot solve for it without messing up some other element of it. It will always be this tension between the two. So anything we can do to satisfy both parties, to make it easier for liquidity to be reached while maintaining the desired comfortability with the underlying asset, and potentially the duration of that asset is super valuable. So we see crypto has been accused of being a solution in search of a problem, right? That's a criticism of crypto and blockchain for some time. And I think in some areas it might be, to be perfectly frank, but in other massive areas, we can solve very, very real problems. And one of those exists in private credit currently.
Could you give me the little bit more grain into what you think is the situation for SMEs and also for institutions? So in the institutional world, mm, there's just such large volumes that efficiency by itself can become a very big, meaningful difference with the prior system. But is there anything else, do you think, from the institutional perspective to what you just said, or does that apply more to, I mean, to everyone in at scale, so to speak?
So I think it starts with institutions. Private credit tends to exist at the institutional level, but the goal ultimately is to leverage the open architecture model of blockchain to allow the massive liquidity that exists in retail to participate in those activities. So let's just think at a very basic level. So how does the average person get yield? The average person who doesn't have access to specific type of credit instruments or any type of private credit tech market, they get yield through their bank accounts. They get yield through money market accounts. Maybe they buy CDs. Maybe they invest in a stock, an ETF that pays a dividend of some sort. Maybe they invest in a bond fund that pays some type of yield. That's how the average person can access yield. And even that is normally subject to going through some type of financial advisor. Um, and as we all know, inflation is on pace to continue to be higher than a typical checking account and savings account yield, which is where most people earn their yield. So we have in the last 20 years, we've had this major flip where keeping your money in a safe place like a GSIB bank erodes your wealth over time versus build it. Now, it was never really a good idea to just leave all your money in a savings account. Obviously, you always should have some type of tiered investment vehicle. But at a minimum, historically, you were somewhat keeping up with inflation. So at least you weren't losing money. Now you're losing, in some cases, meaningful amounts of money because these savings accounts, especially if you have your money in checking, but even these savings accounts are paying, it could be a 3 or 4% less than expected inflation. And that's just the top line inflation. That's not what we would consider real inflation. So the reason that we see Gen Z and younger millennials kind of pushing back on these traditional mechanisms for creating wealth is they're aware that typical yield, is not generating enough to keep up with inflation. So for sophisticated investors or accredited qualified purchasers, we've had the ability to beat those yields historically for a very, very long period of time. And part of that has been private credit because we can invest in these funds that are limited to accredited or qualified purchasers. Now, there are tons of wonderful types of yield everywhere. The problem is unlocking it. Typically, the process of privately securitizing these transactions is very, very expensive. It's expensive, and so you have to charge a high fee for it, and it's expensive and unwieldy. So typically, fund managers who specialize in accessing this yield, they don't want to have a million investors because that's a pain. It's a pain to be synthetically public or to be actually public is a huge pain. And look what happened with Blue Owl. Blue Owl tried to create a publicly accessible vehicle, a quasi publicly accessible vehicle for accessing yield. My understanding of what happened there is they set up structural gates, meaning these weren't gates that got thrown up because there was a problem. These were gates that were designed to minimize outgoing liquidity because that was the whole point of the vehicle. So when the gates were triggered, everyone went nuts on social media. Blue Owl got tarnished. But my understanding is they did exactly what they were supposed to do. So we have we have tons and tons of pockets of yield that can help people beat inflation, but we have no efficient mechanism to get to them. So that's really what blockchain does. I think of it as really as a better distribution system for all things, but yield being one of them.
Understood. I would like you to also comment. Let's go to the public side of the liquidity pool, so to speak, larger pool. Um, there's been lately a regulatory controversy around public equities in the U.S. I'm asking you in a personal capacity. I know that Coinbase has been very vocal. You know, what can you tell us about that controversy? What's your view on it? What's the issue, and how do you think it could be resolved?
Yeah, I mean, look, some people I really like and respect think differently than me on this. I throughout my career, I've spent most of my career at exchanges. What exchanges do ultimately is they try to take risk that trades in fragmented ways, what we used to call over the counter, now you might call DeFi, and create an instrument that satisfies 80% of everybody's needs. But the reason you'll give up that 20% is that it goes onto a centralized exchange, it becomes much more liquid, it becomes much more efficient. That's the function exchanges do. You still have your option. You and I can decide to trade a share of IBM together. We could sit in a bar and say, okay, you know, how much do you want to pay for it? We can write a contract up. We can do all that work, and we can find that's fine. You should always have the option to do that. But if we don't want to spend all of our time doing that, and if we don't want to take the risk, the counterparty risk, we can just choose to buy it from the exchange, and you can sell it to the exchange. So that's why it's good to have both options, centralized and decentralized options. So now throughout the course of my career, whenever we've gone to the OTC market and we've seen kind of what they're trading, they've said, we want to control that. We don't like that you're doing that. Because we have our own special sauce that we've built over years and years and years. And they fight and they fight and they yell and they scream and they sue and they curse at you and they try to stop you. And then you do it anyway. And they hate it in the beginning. But then a liquidity starts to build up. Then after a while, they go, oh, you know what? It'd be so much easier for us just to use this thing on the exchange. And then they become your biggest customers. So I see this very similar. Right now, there's a huge pushback between um, people who don't want to see tokenized equities or tokenized private market shares. The biggest pushback, so there's two different pieces. So one is pre-IPO, private companies. And this has been tried for a very long time. Private companies tend not to like pre-IPO liquidity as it relates to their employees because they don't want those young engineers getting wealthy. They want them young and hungry, and they want them working up until the IPO and maybe even after the IPO, because if they get wealthy, they lose focus. So I think private market's going to have to figure out a way to work with founders to manage that process. Maybe it's by, you can control these tokens to some degree. Maybe it's by limiting the liquidity that companies offer to their employees. That's between the company and the employee. And I do think to some degree, private markets will have to work with these private companies to continue the rules that they set for their employees into the tokenization market. The other reason private companies tend not to want to deal with this is they may have a tight cap table. They may not necessarily want to have a million investors. Now, again, we'll have to work with the private companies to give them some mechanism to protect themselves because some of these private companies don't have big IR functions. So having potentially millions of investors all around the world through DeFi, that's concerning for some of these private companies. So I think tokenization efforts will have to acknowledge that and work with them in some way. But ultimately, those problems pale in comparison to the advantage of having your equity liquid. Because if your equity is super liquid, your investors are more willing to invest in you because they're not going to be locked up. So it's just like everything else I've been through in my career. They're going to yell and scream and complain. But eventually, if you can start to build the liquidity on the back end, that will overcome all of these issues. But we will have to work with them. On the flip side, you have tokenization of currently public companies. And the exchanges are not going to like that, the existing exchanges, because they're like, well, just work through us. We want all that liquidity. But the reality is, three-fourths of the world can't access the New York Stock Exchange or NASDAQ. And so, is there a world where we complement? I don't think it's replacing. We're complementing the liquidity that exists in these wonderful centralized exchanges with tokenization and DeFi, centralized tokenization and DeFi tokenization that allows for the three-fourths of the planet who want exposure to these assets to get it in some way. And it may not be exactly the same rights as if you own the share on the New York Stock Exchange, but it'll be some permutation of that. And again, the people who are our holders in the New York Stock Exchange, they benefit because it's supplemental liquidity to what they're already getting. So I understand why people are scared of it. I understand why they want to fight for some degree selfish reasons. But things like perps, things like asset tokenization ultimately contribute to greater liquidity and a greater good for both the companies and the maybe not the exchanges, but the customers of those exchanges.
Absolutely. I mean, it does seem like in the very long term, it's just everything will be tokenized. The difference between private
Of course.
and public is going to be diffused, if maybe not completely eliminated. But unfortunately, we are a little bit over time, so we have to.
Sorry.
It's okay. It's okay. We have to finish here. Thank you so much.
Only if you invite me. Only if you invite me to Spain. Next one I do in your studio.
You are already invited. I mean, count on that for sure, man. Seriously, you are invited right now, but you also, on the other hand, if you're going to come here, you have to tell me. Deal?
100%. Gracias, Javier.
Thank
Much
you.
appreciated.
Gracias a
Thank
ti.
you.
Thank you. Take care. Bye.